Welcome to the deep dive. So, you asked us to sort of unpack the world of auditing. Think
Mhm.
of it like, how do we know a company's financial homework is actually correct?
Right. And for this, we're using Auditing for Dummies as our guide.
Yeah, seems like a good starting point.
It really is. It lays out the basics pretty well.
Hmm.
Why we need audits, who actually reads these reports, what it takes to be an auditor.
Without getting lost in like super technical jargon, hopefully.
Exactly. It covers the ethics, the actual steps,
Right.
the whole 9 yards, really.
Okay. So, our mission today, pull out the key stuff. What are the core ideas, maybe some surprising bits about verifying financial info?
Yep. Give you a clear sense of what it's all about, the auditor's mindset, the key concepts.
All right, let's dive in then. What is auditing at its most basic level?
Well, fundamentally, it's a systematic process. It's about gathering evidence.
Evidence, like a detective.
Sort of, yeah. Evidence to back up what a company reports, especially those financial statements.
So checking if the numbers are, real.
Pretty much. Making sure they're accurate and reliable. And then, crucially, telling people about the findings.
Telling who?
Anyone who relies on that information. Investors, banks.
Okay. And the main goal for financial statement audits?
It's to give an opinion. Are the statements presented fairly? Do they follow the rules?
The rules being GAAP, generally accepted accounting principles.
That's the one, GAAP. It's the standard rule book for financial reporting in the U.S.
And who makes sure the big companies, the ones trading on stock exchanges, actually get these audits?
That would be the Securities and Exchange Commission, the SEC.
Right.
Yeah, for public companies, think NASDAQ, New York Stock Exchange, the SEC says you need an audit. It's a requirement if you want to sell stock to the public. Gives investors some confidence.
Makes sense. So is that all auditing is? These big public company financial audits?
Oh, no, not at all. That's a big part, sure, but it's broader. You've got forensic audits, for example.
Forensic, like investigating crimes.
Sometimes, yeah. Looking into potential fraud or, financial wrongdoing. Then there are audits for government agencies or nonprofits.
What's the focus there?
Making sure funds, taxpayer money or donations, are used efficiently and effectively for the purpose they were intended. Different goals, different procedures.
Okay, so not just one type of audit. Now let's imagine being an auditor. What's it actually like? Just staring at spreadsheets all day.
Well, numbers are definitely involved, but the book suggests it can be pretty engaging. It's a lot of digging.
Digging.
Yeah, digging through company records, trying to uncover the story behind the numbers, following the trail.
Calling them money.
Exactly. Auditors talk to people in the company. They look at the company's own fraud prevention measures.
Internal controls.
Right, internal controls,
Yeah.
and they use sampling. Can't check everything, so you check a representative part.
Like taking a poll to understand the whole group.
Good analogy.
Yeah.
Yeah, and technology is huge now. Auditors have to keep up because so much data is electronic.
Can't just rely on paper anymore.
Definitely not. You need to understand the systems, the security, and the economy plays a role too.
How so?
Well, when times are tough, the pressure on companies to look good financially can increase.
So more temptation to fudge the numbers.
Potentially. So auditors need to be extra alert then, more skeptical, you could say. Adds another layer.
Sounds challenging. Okay, say someone listening is thinking, maybe this is for me. How do you become an auditor?
The book lays out a pretty standard path. 3 main things. First, education, usually an accounting degree.
Makes sense.
Second, the big hurdle, passing the uniform CPA exam. Certified Public Accountant. It's tough.
I heard that.
And third, often there's an experience requirement. You need to work under a licensed CPA for a certain period.
So that CPA license is key.
Well, absolutely.
Yeah.
The book really stresses this. It's crucial for career prospects in public accounting, definitely. Better jobs, more money, often needed to move up.
Education, exam, experience. Got it. Let's switch to some core auditing ideas. The book mentions materiality, audit risk, evidence, sampling. Can you break those down?
Sure. Let's start with materiality. Think of it as significance.
Significant how?
Is an error or something left out big enough that it might change the decision of someone reading the financial statements?
Like an investor deciding whether to buy stock?
Exactly, that kind of thing. And what's big enough really depends. It's relative. $1 million might be huge for a small company, but maybe not for a giant corporation.
So it's not a fixed number. It depends on the context.
Precisely. Lots of judgment involved.
Yeah.
Then there's audit risk.
Risk for the auditor.
Yes. It's the risk of getting the opinion wrong. Saying the financials are fine when there's actually a major problem. That's the big one.
Or saying there's a problem when there isn't.
That too. But missing a material misstatement is usually the greater concern. It's a bit of a tightrope walk.
So how do they manage that risk?
Through evidence. Gathering enough good evidence, it has to be sufficient enough quantity and appropriate meaning, relevant and reliable.
The good evidence, like from reliable sources.
Exactly. And since checking every single transaction is usually impossible,
Right.
they use sampling. Look at a carefully chosen subset to draw conclusions about the whole pile.
Okay. Materiality, risk, evidence, sampling. Feels foundational. Now, the book talks about management assertions. What's that about?
Assertions. These are basically the claims management makes in the financial statement.
Claims like,
Like, we really did make these sales, or we actually own this equipment, or we've recorded all our expenses. It's their statement that the information is right.
so management puts it out there.
And the auditor's job is to test those specific claims. Those assertions are the targets for the audit procedures.
Okay. Are there different kinds of assertions?
Yes, the book breaks them down. First, for transactions, things like sales, expenses during the year, there's occurrence. Did it actually happen?
How do you check that?
Well, for retail sales, you might compare the cash register summaries, the Z-tapes, to what's recorded in the books. Make sure it's not a phantom sale.
Gotcha. What else for transactions?
Completeness. Were all the transactions that should be there actually recorded? Like, did all the supplier invoices get entered? Then authorization, was it approved? Did the right person sign off on that big purchase order?
Right.
Accuracy, are the amounts correct? Recalculating payroll, for instance. Cut-off right period. Was that December 30th sale recorded in December, not January?
Crucial at year end.
Very. And classification right account. Was the repair expense booked as repairs, not accidentally as a new asset?
Wow, that's a lot just for transactions. What about balances on the books, like assets or liabilities at year end?
Similar ideas there. For account balances, existence, do the assets and liabilities actually exist?
How do you test that? Physically count inventory.
Exactly. Observation is key for inventory existence. Again, completeness. Are all assets, liabilities, equity balances recorded? Rights and obligations. Does the company actually own the assets? Do they really owe the liabilities?
Just because it's on their property doesn't mean they own it.
Could be leased, right? Or consigned inventory. And then valuation and allocation. Are the balances recorded at the proper amount? Is depreciation calculated correctly? Are allowances for doubtful accounts reasonable?
So existence, ownership, and the right dollar value.
You got it. And there's a third category for presentation and disclosure, basically.
Yeah.
How things are shown and explained in the statements and the footnotes.
The footnotes, always important.
Very. Assertions here include occurrence, rights, and obligations. Again, did the things disclosed actually happen and relate to the company? Completeness is everything that needs to be disclosed actually there. Classification and understandability, is it presented clearly? Can someone understand it? And accuracy and valuation, is the disclosed info correct and properly valued?
It really paints a picture of how thorough auditors need to be, hitting all these different angles.
Absolutely. It's a multifaceted check.
Now let's talk ethics. The book really highlights professional standards and ethics. Why are they so critical in auditing?
Oh, they're everything. The entire value of an audit depends on the auditor's integrity and objectivity. Think about it. The company pays the auditor,
Right.
but the auditor's duty isn't just to the company. It's to the public interest, to the investors, the creditors, anyone relying on those financials.
So you can't just tell the client what they want to hear.
Absolutely not. The book points to core principles: integrity, being honest, having strong morals, doing the right thing even if it's tough, being able to disagree with the client.
Standing your ground.
Exactly. Objectivity, being impartial, avoiding conflicts of interest. You had to be independent, not just in fact, but also in appearance. People need to believe you're unbiased.
Appearance matters.
Definitely. And do professional care, basically, doing the job with the skill and diligence expected of a competent auditor.
Sounds like a high bar. The book also mentions Sarbanes-Oxley, SOX, and the PCAOB. What prompted those?
Yes. That came out of some major accounting scandals back in the early 2000s.
Yeah.
Enron, WorldCom, really shook public confidence.
I remember that.
So Sarbanes-Oxley was legislation passed in 2002 to tighten things up. Better corporate governance, more accountability for public companies. And a big part of SOX was creating the Public Company Accounting Oversight Board, the PCAOB.
And what does the PCAOB do?
They set the auditing standards specifically for public companies, and they inspect the audit firms that audit those companies. They're the watchdog for public company audits.
Okay, SOX is the law. PCAOB sets the rules for public companies. What about private companies? Different rules.
Yes. Private company audits are generally governed by Generally Accepted Auditing Standards, or GAS. These are set by the Auditing Standards Board of the AICPA,
AICPA.
American Institute of Certified Public Accountants.
GAS covers the fundamental principles, auditor qualifications, independence, how to actually do the audit fieldwork, planning, controls, evidence, and how to report the findings.
So different standard setters depending on whether the company is public or private.
That's right, though the core principles are quite similar.
Okay, got the standards, the ethics. How does an audit actually kick off the engagement phase?
How?
Well, first off, the book makes a key point. Auditors don't have to take every client that comes knocking.
They can say no.
Absolutely. They need to be able to issue their opinion responsibly. So they do some homework before accepting a client,
Homework like what?
checking out the potential client's management. What's their reputation, their integrity? Are there red flags, like maybe lots of high-level people quitting?
High turnover could be a warning sign.
Could be. They also look for conflicts of interest
Hmm.
and related party transactions.
What are those?
Transactions between the company and people, or entities with close ties like family members of executives,
Yep.
or other companies owned by the same parent. These aren't necessarily bad, but they need careful scrutiny and proper disclosure because the arm's length nature might be questionable.
Transparency is key there. Okay, what else happens before the audit starts?
You need to agree on what services are being provided. It's formalized in an engagement letter.
A contract, basically.
Sort of. It outlines the audit's objectives, management's responsibilities, the auditor's responsibilities, the fees, timelines. Very important document. And the book advises keeping the language clear, avoiding excessive jargon.
So everyone's on the same page.
Exactly. And then you assemble the team. Audits usually involve several people.
Different roles.
Typically, yeah. You might have a partner overseeing everything, managers handling supervision, senior associates leading specific areas, and staff associates doing a lot of the detailed testing.
The grunt work, as the book calls it.
Yeah, sometimes it feels like that. Asking for documents, verifying balances, preparing the working papers.
Working papers. We keep hearing that term. What are they exactly?
They're the auditor's detailed records. Everything they did, the evidence they found, the conclusions they reached. It's the proof backing up their final opinion.
The audit trail.
Precisely. They need to be organized, clear, show who did the work and when. Often indexed so you can follow the logic.
Makes sense. Okay, let's dig deeper into audit evidence. The book mentions 4 key ideas about it.
Right. Nature, competence, sometimes called appropriateness, sufficiency, and evaluation.
Nature.
What form does the evidence take? Is it a document, an email, something you saw, something someone told you?
Okay, and competence or appropriateness.
That's about the quality. How relevant is it? How reliable? Evidence from outside the company, like a bank confirmation sent directly to the auditor, is usually considered more reliable than something just provided by the client.
So source matters.
Big time. And evidence the auditor gets directly is better than evidence obtained indirectly. The effectiveness of the client's internal controls also impacts reliability.
Okay, then sufficiency.
That's the quantity.
Yeah.
Did you get enough evidence? How much is enough depends on the risk involved and the quality of the evidence you're getting.
More risk, need more evidence.
Generally, yes. Or if the evidence isn't super strong, you need more of it.
And the last one, evaluation.
That's stepping back and judging. Does all this evidence actually support what management is claiming in their assertions? Is it convincing? Does it all fit together?
It seems like a lot of judgment calls there.
Huge amount. And that's where professional skepticism comes in again. The book emphasizes this.
Skepticism, meaning you assume they're lying.
No, not necessarily assuming dishonesty, but also not assuming honesty either. It's having a questioning mind, being alert to things that might indicate errors or fraud, critically assessing the evidence, not just taking things at face value.
So a healthy dose of doubt.
But you put it that way, a critical mindset. It drives how you audit, what questions you ask, how deep you dig.
What kind of records do auditors typically look at?
All sorts. The general ledger, which is the main accounting record, various journals, sales journal, cash receipts journal, etc. And importantly, the source documents behind those entries.
Like invoices, contracts.
Exactly. Purchase orders, receiving reports, bank statements, shipping documents, the original proof.
And how do they gather this evidence? What techniques?
Several common ones. Vouching is a big one. Taking an item from the accounting records, like a recorded sale, and tracing it back to the source document, like the shipping slip, to confirm it happened.
Checking for validity.
Right. Tracing goes the other way. Start with a source document, like a supplier invoice, and follow it forward into the accounting records to make sure it got recorded.
Checking for completeness.
Exactly. Then there's observation, watching the client perform a process, like taking inventory. Confirmation, getting info directly from a third party, like asking a customer to confirm their account balance.
Like sending out letters?
Often, yes. Or electronic confirmations now. And inquiry, just asking questions of management and employees. Though inquiry alone usually isn't enough evidence.
Lots of tools.
Right.
And all this work needs to be documented in those working papers.
Absolutely critical. The audit file, the working papers, that's the record. It shows what was done, what was found, and the basis for the opinion. The book mentions dividing it into permanent files.
Stuff relevant over multiple years.
Yeah, like loan agreements, articles of incorporation, descriptions of accounting methods, and current files specific to the year being audited, test work, reconciliations for that year, etc.
And how long do they have to keep this stuff?
For public companies, the PCAOB says audit documentation must be kept for at least 7 years.
Wow. Okay. So a good record is essential. Now, another big area, internal controls. What are they and why do auditors care so much?
Internal controls are the company's own processes and procedures designed to achieve certain goals.
Goals like
Reliable financial reporting, efficient operations, complying with laws, segregation of duties, approvals, reconciliations, safeguarding assets.
things companies do to prevent errors or fraud.
Exactly. And auditors care because the strength or weakness of those controls directly impacts the risk of material misstatement in the financial statements.
So if controls are good, maybe less risk.
Generally, yes. Understanding the client's internal controls is a required part of audit planning. It helps the auditor decide how much other testing they need to do, the nature, timing, and extent of their substantive procedures.
How do they get that understanding?
They ask management, review company policies and flowcharts, maybe look at self-assessments the company did. They observe controls in action, trace transactions through the system called a walkthrough.
And then they test them?
If they plan to rely on the controls to reduce other testing, yes. They need to test the operating effectiveness. Are the controls actually working as designed?
How?
Again, inquiry, looking at documents showing the control was performed, like an initialed invoice for approval, observing the control being done, or even reperforming the control themselves.
Like the auditor does the bank reconciliation again.
Precisely. To see if they get the same result. This all feeds into assessing control risk.
The risk that the controls won't catch a problem.
Right. If control risk is assessed as high, maybe because controls are weak or weren't tested, the auditor has to do more direct testing of the account balances, more substantive testing.
And when does this control testing happen?
It can happen during the year, that's interim testing, or at year end. If controls are tested interim, the auditor usually needs to do some procedures to update their assessment through year end.
Okay, controls are a big piece. Let's revisit sampling quickly. Why is it necessary and what are the risks?
Well, like we said, testing 100% of transactions is usually just not feasible. Too much time, too much cost.
Yeah.
So sampling is essential, but it introduces risk.
Because you might pick an unrepresentative sample.
Exactly. The book mentions 2 key risks. Risk of incorrect acceptance. Your sample looks fine, so you conclude the whole population is fine, but actually it's materially misstated. You missed the problem.
Oops.
Big oops. The other is risk of incorrect rejection. Your sample looks bad, so you conclude the whole population is misstated, but actually it's fine. You found an unusual sample.
So you might raise a false alarm.
Right, which leads to unnecessary extra work. Auditors use statistical methods and professional judgment to design samples that minimize these risks, but the risk never goes away entirely. The book mentions methods like monetary unit sampling for testing balances.
Focusing on dollar amounts.
Yes, and attribute sampling often used for testing controls like what percentage of times was this procedure followed correctly?
Got it. Sampling's a necessary trade-off. Okay, the book then walks through auditing specific areas. We can't cover everything, but maybe hit a few highlights. What about the revenue process?
Okay, revenue, how the company makes money. Big focus here is occurrence. Did the recorded sales actually happen?
We talked about vouching sales back to shipping documents or register tapes.
Right. Also, cutoff is critical for revenue, making sure sales are recorded in the right period, especially around year end. And accuracy, is the amount recorded correct?
What about the purchasing process? Spending money.
Similar themes. Occurrence. Did the company actually receive the goods or services for the expenses recorded? Vouching payments back to invoices and receiving reports. Completeness is really important here, too. Are all liabilities recorded?
How do you test for unrecorded liabilities? That seems tricky.
It is. Auditors often search for them by looking at payments made after the year end to see if they relate to the period being audited. They might review unmatched invoices or purchase orders, also authorization where purchase is properly approved, and cut off again.
Making sure expenses match the right period. Let's do one more inventory. What are the key concerns there?
Inventory is often a big number on the balance sheet, so existence is paramount. Does it actually exist?
That's where observing the physical count comes in.
Yes, that's a crucial procedure. Auditors go watch, do their own test counts. Valuation is also key. Is it recorded at the correct cost? Using an acceptable method like FIFO or LIFO, is there any obsolete or slow-moving stock that needs to be written down?
Checking if it's still worth what the books say.
Exactly. And completeness is all the inventory the company owns actually included. And rights, do they actually own it? Could be consigned. And again, cutoff for purchases and sales affecting inventory counts.
Okay, that gives a good flavor of the specific areas. Now, towards the end of the audit, there's this final due diligence. What happens then?
This is wrapping things up. Looking for anything missed. Considering the big picture. One part is looking at subsequent events.
Events after the balance sheet date.
Right. Things that happen between the year-end date and the date the audit report is actually issued. If something significant happens, like a major fire destroying a factory or a big lawsuit settlement,
That could affect the financial statements for the year just ended.
it could require disclosure or sometimes even an adjustment to the numbers. Auditors also look hard at contingent liabilities.
Potential future losses.
Yes, things that depend on a future event, like the outcome of a lawsuit. Auditors assess the likelihood and estimate the potential amount to determine if it needs to be recorded or just disclosed in the footnotes.
And a really big one at the end is the going concern assessment, right?
Absolutely critical. The auditor has to evaluate if there's substantial doubt about the client's ability to stay in business for at least the next year.
How do they judge that?
Looking at financial trends, recurring losses, negative cash flows.
Hmm.
Also, external factors, maybe losing a major customer, legal troubles, new competition. It's a forward-looking assessment.
Okay, so after all that comes the final product, the audit report. What are the possible outcomes? Is it just pass-fail?
Not quite that simple. The best outcome is the unqualified opinion, sometimes called a clean opinion.
Meaning everything looks good.
It means the auditor concludes the financial statements are presented fairly in all material respects according to GAAP. That's what companies want.
But it's not always unqualified.
No. Sometimes there might be an issue, but it's not pervasive. Then you might get a qualified opinion. Like everything looks fair except for this one specific issue.
Okay, what if things are really wrong?
If the misstatements are so material and pervasive that the financial statements as a whole are misleading, the auditor issues an adverse opinion, that's bad news.
The worst outcome.
Pretty much. Or there's a disclaimer of opinion. This happens when the auditor just couldn't get enough evidence to form an opinion at all. Maybe the client severely limited the scope of the audit.
So they're saying we can't even tell you if these are fair or not.
Exactly. So unqualified, qualified, adverse, or disclaimer. Those are the main types.
Much more nuanced than just pass-fail. And finally, the book briefly mentions services beyond the standard financial audit.
Right. Auditors leverage their skills in other ways. Assurance services in general aim to improve the quality of information. Could be assurance over sustainability reports or cybersecurity controls.
Not just financial numbers.
Correct. Attestation engagements are similar, issuing a report on some subject matter based on criteria. Could be examining forecasts or compliance with regulations. For public companies, we mentioned integrated audits under SOX, auditing both financials and internal controls over financial reporting.
2 opinions in 1 report.
Essentially, yes. And then there are forensic examinations, specifically looking for fraud. That's a specialized area.
So a broad range of services built on that core auditing skill set.
Definitely.
Well, this has been incredibly thorough. A real deep dive into auditing using Auditing for Dummies. Let's try to crystallize some key takeaways.
Okay. I'd say fundamentally, auditing is this disciplined check on financial information. It's not random, it's systematic, guided by strong ethical principles and professional standards.
Yeah, the ethics part seemed really central.
Absolutely. And it revolves around those core ideas. Materiality, what's important, audit risk, the danger of getting it wrong, and evidence needing enough good proof.
Then testing management's claims those assertions.
Exactly. It involves a lot of judgment, skepticism, and ultimately a responsibility to the public, not just the client paying the bill.
And something that struck me was just how crucial independence is. The fact auditors can't even prepare the statements they audit really drives home that need for objectivity.
That's a great point. It maintains that separation.
Also, the different types of audit opinions show it's not a simple thumbs up or thumbs down. There can be important qualifications.
Very true. The opinion tells a specific story.
So, for anyone listening, whether you invest, run a business, or are just curious about how financial accountability works, understanding auditing gives you real insight, doesn't it?
I think so. It helps you appreciate the checks and balances in the system,
Hmm.
the effort that goes into ensuring some level of financial transparency.
And if this sparked interest, where could someone go next?
Oh, lots of places. You could explore the differences between internal auditors who work for the company and external auditors, or dig into forensic accounting cases, or look at how technology is changing auditing,
Yeah, AI and data analytics must be having a huge impact.
for sure. That leads to a final thought, maybe?
Go for it.
Well, consider this. In a world that's just drowning in data, the need for someone to provide trust and verification seems more critical than ever, right?
Makes sense.
So what are the next big challenges for auditing? What innovations will reshape how we verify information in the future? It's definitely something to think about.
A very provocative thought to end on. Thanks for joining us for this deep dive.